Thanks for joining us today on Market Call. I'm Marella Fernandez. Andrey Omelchak on the show with us today, CEO and CIO at LionGuard Capital Management. He'll take your questions on North American small and mid caps. Here's how to reach us. 1-855-326-6266. You can send an email as well, marketcall@bnnbloomberg.ca. Andrey, good to see you. Thanks for coming in.
Great to be here. Thank you.
Markets coming back alive today after being sort of up and down with the conflict going on. You say there are some themes driving the bigger investment. What are you seeing?
Yes, the market's been driven by a lot of different themes, in my opinion. Volatility has been present, but market continues to go up. I think, first of all, it's very important to stay invested, in my opinion, and don't try to make a short-term predictions as to whether you should step outside of the market and go back in. With respect to different themes, of course, the AI data center build-out has been a major theme. Shortage of power infrastructure, electrical grid capacity constraints. This has been a major theme. In Canada, Build Canada is a massive investment theme, in my opinion. I would be happy to discuss that in more detail. And of course, defense. For obvious reasons, the budgets are booming.
When you say people should keep their money invested and not sort of pick and choose or go in and out during this time, what about trimming? Because some of these stocks that are coming back to life, like some of the tech stocks, for example, people might want to trim. Would that be an option on the table for you?
Well, you have to have an opinion about individual securities if you're choosing to do that. With respect to the broad market, it's very difficult to make an assessment whether this is a good time to trim or you should step back in. This is a mistake that retail investors make over and over again. And that's why, on average, they underperform the market by a very significant margin. As it relates to SaaS software tech companies, if that's the core of the question, it feels to me like we're in a bottoming process, trying to figure out whether or not the sell-off is done. And I think the market is getting smarter in understanding who are the winners from AI and who will be disrupted, which business models will be disrupted. So I'm also seeing a bit of an increased caution from AI implementation in certain cases, maybe not by corporations, but certainly by governments. If you talk to various government officials, they're extremely cautious on AI.
As far as implementing it for themselves in office?
I think it's a mix of implementing for their own operations, but also giving access to sensitive data. You really want to make sure the data is separated and that data does not have access to the internet.
So basically sovereign AI, which is what we're hearing a lot about.
That's right. There is sovereign AI, and I think it goes even deeper than that. There is isolation of data within each specific company, so nobody has access to it, but only that specific company. And the computers that are being used to run some of these AI applications don't have access to the broad internet even. So you really have to create this massive Chinese wall between what AI, your internal AI, has access to and access to the broader market, because we've already seen some evidence of the model wanting to break out and go free, so to speak.
Yeah. One in one room, the other in the other room, big wall in between. Andrey Omelchak, our guest today, is taking your questions on North American small and mid-cap stocks. If you'd like to call in or email your questions, here is the information to reach us. We're back in just a moment. Welcome back. Let's go to an email from Rick. He has a question today. He says, any thoughts on Telus? Andrey, I'll turn that over to you. Obviously, telecommunications are a harder space these days, but what are your thoughts on Telus? People are worried about the dividend.
I'm worried about the dividend as well. The payout ratio is very high. Clearly, they have issues with the leverage. They're trying to divest various non-core operations. I'm sure they're going to do some of that. They also have a leadership transition happening this summer. The CEO, after 25, 26 years, is retiring. And we have a new gentleman taking over, ex-CEO of CIBC Bank. I think they need to set the table in such a way that they do cut the dividend. They get in a much better position in terms of reducing leverage and allow the new management team, the new CEO, to really execute some of the growth initiatives they need to do.
What are the growth initiatives for the company?
Well, they're in a challenge industry. Clearly, the ARPU is being pressured down by the competition, so that's not good news. But growth initiatives, they have a Telus Health that's doing really well, but they shall see if they're going to divest that or not. That's a question mark in my mind. So they really have to reset and look at some other alternatives.
Okay, that was for Telus, and that was Rick's question. Let's go to our first phone call. Linda is in St. Albert, Alberta. Linda, go ahead.
Oh, hi. Thank you so very much for taking my call. My call is with regards to WSP and wondering about the professional services that will be offering going forward with regards to the power tech build-out with power centers.
Okay, thank you for the question. We touched on this at the start. Big infrastructure build-out across North America. This is an engineering firm, which should benefit from that. But when we take a look at the stock price, it is down, a little bit of bounce back now. What are your thoughts on WSP? Is there something else that's an overhang for this company?
Yes, WSP is being pressured by the risks around artificial intelligence, disruption of some of the businesses. I think those concerns are more than overblown. And actually, I believe WSP is going to benefit as a result of that. Of course, the pricing structure is changing, so especially on the lower end type of offering. But overall, they're implementing AI in a big way across the company. And I think it's going to lead to the margin expansion for the business. And the question is a very smart one. They are benefiting from AI build-out, from data center build-out. They're a participant, and they intend to be a bigger participant in that space.
Would you pick it up where it is today, believing in a bounce back, or would you hold off?
So it's very interesting because I believe that AI concerns are starting to abate. To some extent, we're seeing that with the software as a service. And as a result, we can extrapolate some of that dynamics onto some other companies, such as WSP Global in this case. So whereas 3 months ago, I would be more cautious, thinking that it can be pressured even more by AI concerns. Now I believe that the sell-off, the pressure is probably mostly done. So I would be accumulating and picking it up on a pullback.
Let's go to our next caller then. Andrew's on the line. He's in Winnipeg with his question. Andrew, sorry, we're going to Dean next. Is that correct? I jumped ahead. Dean is in Calgary today. Dean, go ahead.
Hi, Andrey. Just your thoughts on Propel Holdings, and would it be a buy at this point? Thank you.
Okay, we talked about software concerns. What about private credit? Propel is in that space, and it has come down quite a bit.
Propel is a high-quality company, really well run. Oftentimes, investors misconceive it as having similar business model to GoEasy. It has very little to do with GoEasy. So if it sells off on the back of those concerns, that would be a buying opportunity. I believe that the private credit concerns do not translate onto the...
Can you explain the difference between the companies? You said they're not really the same as GoEasy. How are they different?
Well, there's much more transparency in their operations, into the underlying business. They stick into what they do best, which is clearly giving those short-term loans to people in need, and they charge for that accordingly, of course. And they have a very good visibility on the payback. So the velocity of getting the capital back is very high. So if they're more concerned on the credit side, they can really close it up. If they get more optimistic, they can really open it up. So that provides a tremendous flexibility in adopting the business model to changing market conditions, be it on the credit side or elsewhere. So they're not involved in any auto prime financing or any other issues that GoEasy has run into. So I think Propel is accumulate on the pullback type of situation. I think over the next several years, it will be a good compounder. But could it be a volatile ride? It could be, as it has proven already, because of those misconceptions around that business.
All right, let's get to our next caller then, which is Andrew in Winnipeg. Andrew, go ahead.
Hi, can I get your guest thoughts on Well Health?
Sure.
And does he own it? Thank you.
Thank you for the question. Well Health, we haven't discussed in a while. Tell me a little bit more about, first of all, if you own it, and second of all, whether it's a stock that you like.
I do own Well Health, and it's a company which I like. I have gotten involved with Well Health just last year after watching the company for many years. I believe they're in the middle of transformation. They're planning to divest the non-core operations in the US, which are highly unprofitable, and they run into some issues there. So everybody is looking forward for that to be off the books. Also, they're in the process of IPOing Wellstar, which is their crown jewel technology company, which I believe will come at a very healthy multiples, despite the concerns we have around technology companies these days. That business is doing really well and growing nicely organically. ARPU is expanding nicely.
What's the timeline for getting rid of their operation in the U.S.? I remember talking about this months ago, so I'm just wondering if that's going to take a full year. Is that the estimate?
It is taken longer than everybody's expecting, so that's a negative on the story. But management team is clearly committed. They're trying not to sell it at garage sale prices, so this is understandable. I believe by the end of this year, all of this will be off the books. At least 2 out of the 3 assets will be sold. So if you have to wait a little bit, it'd be okay to wait. On the positive side, Canadian operations, Canadian clinics are doing really, really well. They just published this week the data on the Canadian clinics, and they're growing nicely, organically. The patients' visits are up a lot. And WELL Health is really focused on consolidating that space. So now they have about 2% market share only. They can go to 10% plus easily. And that business provides a true compounding effect to the operations. Once they clean up US operations and once they IPO Wellstar and focus on Canada, I think there's a very good potential it might become one of the compounders in Canada.
I'll take a quick break on that note. Andrey Omelchak of LionGuard Capital Management taking your questions on North American small and mid caps. Back in a moment. Welcome back to Market Call. Mike is on the line. He's in Toronto with a question. Mike, go ahead.
Hi, I've been a long-term shareholder of Bird Construction from the Stuart Olson takeover, and I got a little more recently. Do you think it's time to trim a bit with a strong run-up?
Thank you for the question. Bird Construction, nice line there through all of last year. What do you think?
I'm very bullish on Bird Construction, despite the stock price run-up. I think it's fully warranted. They have a booming backlog that grew 45% year over year as of the end of the last quarter. They have a clear path towards margin expansion. They're directly exposed towards a Build Canada theme. They have a multi-year visibility, I believe, for business to grow organically at a very fast pace. And they're also adding some business for the acquisitions, very strategic, very accretive acquisitions. So I think it's a top management team at the right place at the right time. The whole multiple for the industry has gotten re-rated for the obvious reasons. But if you look 2 years out, it's actually trading at a very attractive multiple. So you really should not be looking at the next 12 months. So the industry has gotten structurally tremendously better, and Bird Construction is a net beneficiary of that. So I would not be selling or trimming aggressively on this run-up.
There's more run-up to come, perhaps. Okay, let's get to our next email from Paul. I have a position in ATCO, which I purchased about 6 months ago. Your thoughts on ATCO as an investment for the next 12 to 24 months would be appreciated. Let's take a look at the ATCO line, if we have it there, and see how or where it's going. What do you think of ATCO?
So I'm actually not too familiar with the ATCO as a business, so I cannot comment too intelligently. But I can tell you they have a division focused on the modular housing units, and I'm very, very bullish on that division, on that whole business. This much I can tell you.
In Canada, I know that was some of the, Mark Carney sort of was looking at this kind of housing that can be built very quickly.
Yes, that's part of it. So they're going to benefit from that as well. And also, as it relates to the big infrastructure projects and the build-out, they have a division that's going to benefit from that because they have a modular housing units that can be put to work quickly. And they're displaceable. They can be moved to another location. So that business is absolutely booming. As it relates to the rest of the business, unfortunately, I cannot comment.
Okay, let's get to our next phone call then from Tony in Calgary. Go ahead, Tony.
Yeah, I'd like to ask the guest about the Lumine Group. Does he own it? And would he buy that, or does he like Constellation or Topicus better? Thanks.
Okay, thank you for the question. Do you own any of those?
Yes.
Lumine, Constellation?
We own Lumine and Constellation software. We have exited Topicus just because we have a preference towards Lumine.
Okay.
We did own it in the past as well. We think that the big sell-off in SaaS and especially vertical market software is very much overdone. We think that artificial intelligence is not going to disrupt their business models. They're actively implementing AI across the company. They're deploying capital in a big way. Constellation Software just announced number of transactions. They're running at a very high capital deployment pace, and they have not sacrificed their internal rate of return to do that. So Lumine Group just closed the big acquisition they announced earlier. They expect major benefits in terms of the margin improvement from that. And Lumine in particular is the least exposed to AI disruption because it's so much vertically integrated, it's so mission critical.
I was going to ask, what are when you're looking at the software space and trying to determine who's going to win from AI and who's going to be left behind, what criteria are you using?
I'm looking for criteria of how difficult it is to implement a software solution, how mission critical it is, what type of data it has access to. If it has access to very sensitive, critical data, chances are the companies would be extremely hesitant to implement that, to my earlier comment. So that's what I look for. And they're seeing that through all the conversations with the CEOs and CFOs. There's no disruption happening for those type of companies, at least until now. You also have to study and understand the offering within the whole offer, how much software represents. And typically it's around 20% of the whole offering. So there's a whole 75 to 80% remaining, which is a go-to-market strategy, service and function, accounting, you name it. There's a whole list of things, whereas the software development itself is only about 20, 25% of the offering. But it depends on the business. Some businesses it's much higher. In that case, SaaS can truly come in and provide something at a fraction of the cost. And if it's easy to disrupt and easy to change, it's not mission critical, that's where you want to be very, very careful. But on Lumine specifically, I'm very bullish. I own Lumine, and we really like what they're doing.
Let's get to our next caller then before the break. Elliot in Hamilton, Ontario. Elliot, go ahead.
Good afternoon. On the pullback, premium brands, is it now good value or still overpriced? Thank you.
Thanks for the question. Tell me about premium brands.
So premium brand holdings, they have quite a bit of excess capacity they're trying to fill, especially in the US after years of investing. But they seem to stumble over and over again in filling that capacity. I also think it's exposed a bit to the economic cycle and to consumer sensitivity. So I'm not too bullish on that. I think we need to see better execution from premium brands. Enough of the stumbles. It's time to see a clear path towards filling up the excess capacity. So I'm quite cautious. I also am not a big fan of the accounting practices. It's a bit of aggressive on my side. If you look at the adjusted EBITDA numbers and you go through the fine print, you can see that there are a number of additional adjustments that the analyst should make to come to the true free cash flow generation and probably more fair EBITDA numbers.
You mentioned consumer sentiment. Is that regarding sort of processed foods and people moving away from that? Has that been a big hit for the company?
It's mostly on the sandwiches side that I'm worried about. And this moves back and forth, of course. But processed foods, I think, has been okay for the most part.
All right, let's take a quick break then. We're going to come back with a look at Andrey's past picks. That's next. Welcome back. Time to go through past picks from Andrey. These are from September 16th of last year. At the time, he chose Electrovaya, ELVA on the TSX. They do lithium-ion batteries, recommended at 822, now to 1337, so 63% upside, 63% total return. This is a smaller company just outside of Toronto. Have you remained invested in it?
Yes, I'm a big investor in Electrovaya. And I remain as bullish as I have been, despite
Explain your case, yeah.
Yes, it's a lithium-ion battery manufacturer expanding into the fast verticals, which are absolutely booming. So they're talking about defense verticals. They just signed the 2 defense contracts and the 2 other ones they're talking to. They're also talking about robotics and warehouse automation. As you can imagine, those warehouses need to more and more robots moving things around, not individuals. So that's booming. Onshoring theme is happening in a big way. Also keep in mind, nobody wants to buy batteries from Chinese manufacturers, which are flooding North American market. So they're looking for alternative solutions. In case of Electrovaya, they have the longest battery life for the batteries that they're making, but they also are the safest of the industry. So they're working with the likes of Walmart. I also believe they're working with the likes of Amazon. They have a partnership with Toyota. So they're really top of the industry in terms of the product quality. They're expanding their manufacturing capacity through the Jamestown, New York production facility. They're tripling their capacity, as a matter of fact. Last year, they grew about 40% organically. They're guiding for 30% growth for this year, which I think is very conservative. The management team likes to underpromise and overdeliver, which I like a lot. Mm-hmm. There's high insider ownership with the company. So it's the Jamestown facility will more than triple their revenue, but it's also going to come at a much higher gross margins.
And that's being built. It's not complete yet.
It's been built right now. It's progressing well. I expect for this to be complete by the end of this year. So it will be a big contributor to the results starting in fiscal 2027. And there's also another element of this company. They're actively working to figure out the solution for data centers to provide the mission-critical backup power generation. So if the data center goes dark, even for a minute, is a massive problem. So it needs to always be online. So there are various providers that fix those solutions, and they come in with a solution that is providing the short, high-power duration.
In between.
So, in between. So if that happens, that could be transformative for the business.
Let's get to your next past pick from September. TFI International, it was 131.52 last year, and now to 185.23. So 41% return, 42% total return. They do transportation logistics. Do you remember what you liked about them last September? What drove your interest here?
Yes, of course, absolutely. So the trucking industry was in a 3-year recession. Typically, trucking recession lasts 18 to 24 months. So 3 years is a much exacerbated trucking recession. So I felt that the industry is about to come out of the recession. Of course, you need to take the excess capacity. You need to have a bit of a response on the demand side as well. So first, it's an industry call. Second, it's a company-specific call. They're less than truckload operations. They were doing a lot of organic improvements. Less missed pickups, better accounting system, better billing system. I can go on and on of what you can do organically within your control to improve the underlying company's operations. And from what I saw and what I read, these were real improvements which companies been successful in executing. Another thing I liked is that the company was trading at ridiculous multiples and very high free cash flow yield. On a normalized basis, based on my math, they were trading at 13-14% free cash flow yield for this type of quality operator. Now, the company is up 75% over the last 12 months. So I accumulated a lot of it on a pullback. And in the full transparency, I just sold my position in TFI to put the capital elsewhere to work. Now, having said so, I think the industry is improving, and I think they're doing all the right steps still. So maybe I have sold too early, but opportunity cost of capital is always very high.
Let's get to your third pick then. Mattercore, MATR on the TSX. At the time, it was $11.42 down to $9.50 today. So 17% loss or 17% total return loss. They do energy, infrastructure, technology. What happened to Matter in the last number of months?
Matter is undergoing a lot of challenges which they're trying to fix. I believe it's in the deep value territory right now, but they are missing a positive catalyst. They're also exposed to the tariffs uncertainty, which I don't like, especially as we go into USMCA renegotiations. Management is cautious now on the fiscal 2026. What I liked before is they were aggressive in buying back stock, but at this point, the leverage is elevated. So they stopped the buybacks, and now they're trying to reduce the leverage. I think there's a limited visibility for me in the near term over the next several quarters with how Matter will unfold. But I think if we're patient and over the next minimum 2 years, 2 to 5 years, this could be a very, very high upside situation. But because of this opportunity cost of capital, I decided to exit the position, actually. And I'm looking forward for that greater visibility to get back into the story.
So it's one you're keeping a watch on.
Yeah.
Let's take a quick break, then we will come back with more of your questions in just a moment. All right, welcome back to Market Call. Rob's on the line. He's in Calgary, and he's got a question today. Rob, go ahead.
Hi, thanks for taking my call. I've been picking away at Exchange Income Corp in the last while, and despite a great earnings report at the end of February and a nice spike upward at the time, the stock has given back its recent gains and is down again today. Is this a buying opportunity, Andre, or should I wait a while for this volatility to calm down? Thanks for your advice.
Thank you for the question. Sometimes we see things line up in a stock, but it doesn't materialize in the price of the stock. Or we see things line up in a business, it doesn't materialize in the stock price. What is going on with Exchange Income, and is it a company that you like?
I like Exchange Income. Business is doing really well. Their backlog is growing nicely. It's playing really well into the nation building and Canadian defense and our sovereignty objectives as well. So I think the business is doing really well. The stock price is reflecting that. But I think if you have a longer-term view, you can still make quite a bit of money owning this company. But I would say that the rabbit is out of the hat. Everybody knows it's a great business. Everybody knows they have a structural tailwind. They will be benefiting from Canadian government spending and the growth up north. Having said so, I think it's a good company to own.
Would you pick it up where it is today, over $100?
I would be investing some of the capital at these levels. I would be accumulating. I would be hoping for the pullback, but I'm not sure we're going to get that much of the pullback because it has a very good following, and a lot of investors would like to buy it on the pullback.
Let's go to the next phone call then. Faisal's on the line. He's in Toronto. Faisal, go ahead.
Oh, hi, Mirella. Good afternoon to you and Andre, and thank you for taking my call. Andre, can I get your thoughts on Kraken Robotics, primarily its growth prospects, and would you be buying it at this point? I'll hang up and listen. Thank you.
Thank you for the question. Kraken we've discussed on and off. I imagine it would benefit from defense spending.
It is benefiting tremendously from defense spending. I'm a current shareholder of Kraken Robotics, and I'm very bullish on the business. Of course, it has run up a lot. But I think if you look into the pipeline of their business, you can see that it has much more to offer. I also like the recent acquisition they did of a European company. I think it's a very smart acquisition. They can cross-sell some product as a result. I think it's a top management team. I think they're in the right vertical. They're poised to benefit from defense budgets in a big way. And they have a differentiated product. There are several providers that have this unmanned underwater surveillance and offerings. But the fact that they're based in Canada, clearly they're going to get a lot of Canadian government participation. And also they're winning a number of contracts out of Europe and other nations aligned with the Western world.
Just to give people an idea of the run-up, last year, so a year ago today, it was $2.18. It's up to $8.38 today. So you think there's room still for it to go?
I think sometimes you have to look forward and not backwards, and this is one of those examples. Is this a huge weight for me? Absolutely not. But I believe that, I actually missed a lot of the rally and have gotten involved not too long ago. But you have to change your mind. You have to adapt, and you have to learn from your mistakes, which is one of those cases. And I'm looking forward, and I'm saying the business is doing well. Management team is committed. What we're seeing right now happening in the Middle East further highlights the fact that you need to have a proper defense capabilities and offensive capabilities for the underwater solutions. So I think what we're seeing on the defense budget side will translate directly into the results.
Let's get to the next caller then. Dave is on the line. He's in Winnipeg. Dave, go ahead. Dave, are you there? Okay, we may have lost Dave. Let's take a quick break then. We have Andrey Omelchak here with us today from LionGuard Capital. He will take your questions on North American small and mid caps when we come back. Welcome back. John's on the line. He's in Oshawa, Ontario. He has a question today for Andre. John, go ahead.
Hi, Hi, Andre. Thank you for taking my call. Hi, Marella. My question is on MDA Space. Going forward, what is your opinion on that? Because recently, in the recent past, some contracts were taken off from underneath their feet by another U.S. company. So since then, they have bounced back. And what do you think about the MDA Space? Thank you.
Thank you for the question. MDA Space has American competitors, obviously, and it lost a contract last fall. It's gone a little sideways. I mean, it sort of never gets past the 45, 46 mark is what it seems like. Do you like MDA Space? Is it one you've invested in?
I'm currently invested in MDA Space. I like the company a lot. I think the prior concerns around them losing contracts are overblown, and the pipeline actually is massive of the new business that they can sign on. The last communication the management team did, they have over $40 billion of the pipeline they're bidding on. And I think they're going to win a big contract potentially from Canadian government as well. So that's been contemplated, and I believe they're going to be the one who's going to win it. Clearly, if you're a Canadian government, you're not going to give that contract to, in the current environment, to an American company or any other company for that matter, because MDA Space, one of the best in what they do in the world, and that's why they're winning contracts from a bunch of other countries as well. So I think it's been in the consolidation phase, but now they're going to have a SpaceX IPO soon. And we're going to have other companies IPO as well in the US. And that's going to provide a sense of the valuation multiples assigned to this type of businesses. And if you think that way, MDA Space is extremely cheap. And I believe the management team is doing a great job as well. They ramped up their facilities nicely. They hired a lot of people, which was my concern, but they seem to be working well. And I think they have a lot of more capacity now at this point to add more clients.
They opened up a plant, I think, in Montreal or near Montreal. Do you know if that's up and running yet for them?
Yes, I mean, it's up and running, and they're expanding the capacity. Yes, the plant is in Bay d'Orfay in Quebec, right next to the Montreal downtown. It's a phenomenal facility, state-of-the-art facility. And it's working well. The problem they have is they hired so many people, they need to expand their parking. So business is doing well. Recently, Canadian government actually, our Prime Minister made an announcement, about investing more in defense, and that was made from that facility. So reading the tea leaves, I doubt this company will be forgotten when it comes to the defense budget allocations.
Let's get to an email here from Bob. If or when quantum computing actually becomes viable, what areas in tech are most at risk besides current security forms? I'm not sure if this was a question you said you could speak to.
I said yes, just to try to challenge myself.
Okay.
And maybe have a bit of fun with the show and to think out loud as well.
Go ahead.
I'm not a subject matter expert on quantum computing by no means. But what I want to communicate is that there's still some work to be done for quantum computing to become real. But once it does become real, it does not have a very broad application across the tech stack. It has a very narrow niche applications, but within those narrow niches, it will have a tremendous impact.
Can you give me an idea of where it would be applied?
Yes, so anything in relation to securities, cybersecurity, any of these protective layers can be easily broken if you have quantum computing in place. So those companies have to adapt, change. I'm not sure exactly how they will do that, but there's a big risk for those type of businesses. But there are some very positive applications too. If you think of biotechnology, if you think of material science, there will be major drug discoveries happening as a result of that. So actually, companies that have existing drug portfolio, maybe has one big drug that's a huge success, now will be at risk of new discoveries happening by the smaller companies. So there will be some big disruption happening there. And I can go on and on, but it will not be broad-based. Like a SaaS companies, for example, are not at risk.
Okay, so it's very niche. Let's get to our next caller then. William, who's on the line in London, Ontario. William, go ahead.
Good afternoon. Thank you for your past suggestions. I'm thinking of changing my EQB into Royal Bank. Do you have an opinion, please?
Thank you for the question. Royal Bank's always a sort of safe bet in finance, yes?
It is. It is a safe bet, but EQB is also a great company. So I'm a big fan of EQB, actually. I think Chadwick is a phenomenal CEO. And I think he will take the company to the new heights.
Do you think there's more growth there than for Royal Bank? Some people worry about the valuation for the financials.
I think both are buy in my books. Royal Bank you buy for stability, for that huge infrastructure they have built, for the capital markets as well, which is doing really well. So I think Royal Bank should continue doing well. I'm not too worried about consumer credit impact. I think they're sufficiently provisioned for that. So Royal Bank, in my opinion, is a very solid hold for the longer term. I'm not worried about that business, but I think that EQB will most likely outperform over the next 3 to 5 years because they're starting from a much smaller base, because the organic growth rate will be that much higher, and because it's much more agile and flexible organization. It's digitally native. So it's built to adapt, it's built to introduce new products, which they're liking quite a bit.
Is there a headwind for the company that you see?
Well, the headwind would be around the housing market in the GTA, and everybody knows that. But at the same time, they have navigated it well. They don't have that much write-offs at all. In fact, anything they put in non-performing loan formations usually come back afterwards. So they have a very conservative provisioning, and they have a top management team once again.
You mentioned that you're not concerned with the private credit storyline for a bank like Royal Bank. Do you have concerns about private credit for any of the other bigger institutional? Or are they all too big and too sort of positioned with their credit loss division that it's not a problem for them?
I would have to look company by company to figure out the private credit exposure, to be fair. But clearly, there's everybody wants to be out at the same time, out of the private credit. And clearly, there has been some bad actors in the private credit as well. When you operate in a close to zero interest rate environment, you deploy the capital at those levels, and you take on leverage on top of that, you're bound to have some issues. Now, not all private credit is the same. There are some great operators within the private credit that generate very stable, recurring business. So you have to look at the business model. And I have not seen big book exposures within the Canadian banks on the private credit side that makes me worried structurally.
Okay. Let's see if we can get to an email before the break. From Holland, what does the guest think about Microsoft? Would he be buying in at these levels? Are you in any of the Mag 7? Is Microsoft one that you do own?
So I specialize in small and mid-cap equities. And the reason for that is because that's where you find tremendous inefficiencies and structural inefficiencies. I believe you can generate tremendous alpha by focusing on that niche. And that's why I'm focused.
And that's where you keep it.
Having said so, as part of my process, I have to study large cap equities because it gives me a sense of what is happening underneath for the small cap companies. So I do follow Microsoft at a higher level. And of course, I'm a huge fan of the business and what they've done. The number one question you want to ask is the pricing power of the company. And I can tell you, if they were to double their Office subscription tomorrow, I'm going to pay that across my company.
Because it's so embedded in your company, you rely on it every day.
That's right. It's very much embedded in our operations. There's nothing we can do today to go and do something else. And also Microsoft has a bunch of other product offerings, which they continue to embed within the operations. Having said so, I think their Copilot offering is not up to par with other AI native initiatives, such as, of course, ChatGPT or Claude and others. I think they have a lot of work to do there. On the positive side, they have printed very good numbers on Azure front last quarter, which I thought was good. So I think you're safe to keep holding Microsoft, despite this being a multi-trillion-dollar company.
Yeah, they've put Copilot into their software now, so people who have Microsoft now have access to Copilot a lot of the time, which is a great way for them to introduce that product to new users all the time. They could benefit from that. We'll get to new top picks from Andrey when we come back. Stay tuned. Tomorrow on Market Call, Gordon Reid will be with us on the show, President, CEO of Good Reid Investment Counsel. He'll take your questions tomorrow on U.S. equities. Let's get to new top picks from Andrey. We're going to start with Magellan Aerospace, MAL, on the TSX. We were just talking about them a bit at the break. They're defense, but you're saying people don't really know much about them.
It's a very much undiscovered company because they have a very high insider ownership. There's one individual that owns more than 50% of the company. It doesn't screen too well for institutional investors as a result of that. But the business is absolutely booming. It's a defense and aerospace company. Defense now accounts for approximately 30% of the business, and I believe can go as high as 45 to 50% of the business. The aerospace also is doing really well. Of course, they work with Airbus and Boeing, which reported today. You can see their backlog numbers. It's stunning how much work they have to do. So what we're seeing right now from Magellan, we're seeing a record request for proposals, especially as it relates to their defense business. Of course, they're working with Canada Defense. They have a number of European nations, I believe, that will become and already are clients of Magellan. I think they have a huge operating leverage right now in the business. So as new business comes in, it will come at much higher incremental margin. And as a result, you can have much more free cash flow generation. The whole aerospace and defense complex already have re-rated to the large extent. And even though Magellan stock price looks like it's done really well, in terms of multiples, it's probably one of the cheapest companies you can find, if not the cheapest across North America. So I think investors need to do a bit more digging. And I think we have a very good visibility onto the numbers doing much better.
Let's get to your next pick then, which is Stingray Group, RAY and the TSX. Essentially, digital advertising, I guess, is the main part of what they do?
So it's a streaming media company. So they have different verticals. They have three main verticals, how they distribute that media. So think of audio and video content, which is being distributed through either TV, connected TV channel, either through the in-car entertainment, or during the retail. So if you go shopping and you hear the music, there's a good chance it's Stingray that's providing that music to that retail location. So what we're seeing is a double-digit growth from the company, as well as the margin expansion. They also made very smart, very strategic acquisitions, which are very accretive, in my opinion, and will accelerate organic growth rate for the company. On the audio side, they already signed partnerships with Tesla, with BYD, with Audi, with Nissan, and there are more coming. And this will start contributing to the bottom line more significantly in the fiscal 27 and afterwards. So it's a very strong free cash flow generation. It pays already double-digit free cash flow yield today. It's undiscovered Quebec-based company that has high insider ownership. So the real interests are aligned there, which I like.
Okay.
And also, I believe it's a potential takeout candidate at this point.
Let's get quickly then to your last pick, which is Black Diamond Group, BDI, and the TSX, which you're following a theme here of the build-out of the nation-building projects, another company that could benefit there.
Yeah, Black Diamond is directly exposed to nation building. They have a big fleet of mobile units, which they can move tomorrow if they need to the new location in a very short order. This does not require incremental capital at all. So the units they're going to put to work for the nation-building projects will be highly profitable for the company. Also, I believe the whole industry is going to tighten tremendously. Even one big project announcement will lead to the tightening of the industry. But if you look at the pipeline of those projects coming, what has been announced by the government, there are a number of them coming over the next 3 to 18 months. So there will be a big tightness in the industry, which will lead, of course, to deployment of the unused capacity, but also a much better pricing impact. At the same time, the company is generating a lot of free cash flow. It has a high insider ownership. Management team is top-notch. They're also trying to get exposure to data center build-outs. Not all of them are built close to urban centers. Sometimes the workers that build those need to live within those housing units. So there's a lot of things working for the company, and at the same time, it's very cheap, in my opinion.
Want to step into. We do have to leave it there, Andrey. Thanks for coming in. Appreciate your time.
Thank you very much.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.